All right, if you're a freelancer or a gig worker, you know that feeling when the 1099 form lands in your inbox. It can be a bit of a mixed blessing, right? Well, today we are diving deep into a hidden tax trap that, believe me, could be costing you thousands. Let's get into it. So, you get that Form 1099 NEC. You open it up, you see that big gross number, and oof, the tax bill just feels huge, doesn't it? And it's so natural to start wondering, wait a minute, am I being misclassified? Am I paying too much? But as we're about to find out, the answer, well, it's not nearly as simple as you think. Okay, so first things first, let's talk about what I call the 1099 surprise. You know, that moment of shock when you realize just how different your tax burden is when you're a contractor. It really is a tale of two tax rates. See, here's the fundamental difference. The big one. If you're a W-2 employee, your employer pays half of your FICA taxes. That's Social Security and Medicare. But if you're a 1099 contractor, you are on the hook for the entire thing, both the employee's share and what would have been the employer's share. And this is the number that really hits contractors right where it hurts, 15.3%. Yep, that is the full self-employment tax rate. And remember, that's on top of your regular federal and state income taxes. And here's where the temptation really kicks in. A regular W-2 employee, they only pay 7.65%, exactly half. So when you're staring at that 15.3%, it's so easy to look at this number and think, man, I'm definitely being misclassified. I'm losing a ton of money. That 7.65% difference, it's a really, really powerful motivator. Okay, but here's the big question. Are you actually misclassified? Because it's not just about what you or your client calls you. Oh no, the IRS has a very specific set of rules to figure out what your real status is. So let's take a look at how they actually decide. So the IRS uses something called the common law rule. And really, it all boils down to one single concept, the right to control. And this is a super important distinction. It's not about whether the business is micromanaging you every second of the day. It's about whether they have the legal right to if they wanted to. And the IRS breaks this whole right to control idea down into three big buckets. First, you've got behavioral control. You know, do they tell you when to work, where to work, how to do your job? Then there's financial control. Who's in charge of the business side of things? How are you paid? Do they reimburse you for expenses? And finally, there's the type of relationship. Things like, is there a written contract? Are you getting employee-style benefits? Is this meant to be a permanent gig? All right, so let's say you've looked at all those rules, you've thought about your situation, and you're convinced. You think, I am an employee. So what do you do now? Well, let's look at the official IRS fix. Here's how the official process works. Step 1, you file a Form SS-8. Now, this is a super detailed questionnaire where you're basically asking the IRS to step in and make a formal decision on your worker status. Then, while you're waiting for them to decide, you file a different form, Form 8919, right along with your tax return. And what this does is it lets you pay only that 7.65% employee share of FICA taxes upfront. And here's our first reality check. That quote right there is from the IRS itself. Be aware that it can take at least 6 months to get a decision. At least. In the real world, it can often take a lot longer than that. So yeah, this is definitely not a quick fix. Okay, now we get to the real heart of the issue, the twist. Imagine this. You've filed all the forms, you've waited months, maybe even longer, and you win. The IRS agrees you should have been an employee. This feels like a huge financial victory, right? You should be celebrating. But for so many people, this is the exact moment a hidden trap springs shut. So what's the trap? Well, there's a hidden cost to winning this reclassification battle, and it all comes from a massive change in the tax code that happened back in 2017, the Tax Cuts and Jobs Act, because that law completely suspended the deduction for unreimbursed employee expenses on your federal tax return. And trust me, this changes everything. Let's just run the numbers so you can see exactly how this works. Let's say you earned $100,000 and had $20,000 in totally legitimate business expenses. You know, your laptop, software, travel, whatever. As a contractor, no problem. You deduct those expenses and your taxable income is 80 grand. Simple, right? But the moment you're reclassified as an employee, you can no longer deduct that $20,000 in expenses on your federal return. All of a sudden, your taxable income shoots right back up to the full $100,000. This is what's known as phantom income. It's a killer. You are now being taxed on $20,000 that you never even saw. It went straight out the door to pay for your business expenses. So even though you saved that 7.65% on FICA taxes, the extra income tax you now have to pay on that phantom 20 grand could easily wipe out those savings, and then some. It's the classic case of winning the battle but losing the financial war. But wait, the story isn't quite over yet. There is a potential lifeline here, but it all depends on where you live. We need to look at a possible state-level solution. So here's the thing. Some states, like New York, for example, have basically said, nope, we're not following the federal government on this one. They've decoupled from those federal changes. This means that on their state tax returns, they still allow you to deduct those unreimbursed employee expenses. So you could potentially claw back some of those deductions, at least on your state tax. And all of this brings us right back to the final calculation, your final calculation. Because the decision to challenge your 1099 status, man, it is anything but simple. This isn't about right or wrong. It's a really complex financial calculation that has very real consequences. So the takeaway here is this. Before you even think about filing that Form SS-8, you have to do the math. You have to ask yourself, will the money I save from cutting my self-employment tax in half be more than the extra income tax I'm going to owe on all my business expenses? What are the rules in my specific state? The answer isn't universal. It's in your own numbers, and it really demands a very, very careful look at your real bottom line.